Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. US government shutdown looms. The Republican-led House rejects a funding plan backed by Donald Trump just hours before today's deadline to keep the US government running. European and US futures are lower as traders await the Fed's preferred inflation gauge later today. This as President-elect Trump dials up the tariff rhetoric against Europe. And the Bank of England's Governor Bailey insists on a dovish hold, capping a big week for central banks. More UK data shortly.
In the meantime, a quick check on these markets. Red on the screen when you look at the futures picture. A lot of it really concentrated on the continent. FTSE 100 basically flat right now. Euro Stoxx 50 futures down a whopping 0.7%. In the same vein, Eurodollar at a 103 handle. Slight strength against the dollar today, but we'll see if that lasts. In cable at 125. The countdown to the opening trade starts right now.
Very disappointing to us that all but two Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon. Again, the only difference on this legislation was that we would push the debt ceiling to January of 2027.
US House Speaker Mike Johnson speaking after the vote in Congress defeating the Trump-backed government funding bill. Mike Johnson definitely already has a Trump problem. Do the markets now have a Trump problem? Look, at the beginning of this week, we thought the Fed was going to be cutting, that everything was going to be good. The markets were on board with that as a concept, and they thought that Trump was only going to deliver good things and that we were off to the races and life was going to be pretty good. At the end of this week, Kriti, it feels pretty different.
It feels completely different. It may not even be priced in the markets, but I think what Mike Johnson needs to face is that in a couple of weeks, he may not have a job because of the way that this is going, in addition to the fact that we're still looking at a federal government shutdown looming in the next, 23 hours and counting, I believe. And on top of that, a debt ceiling story that Donald Trump has now decided to weigh into, potentially not just extending it into 2027, but into maybe 2029, or maybe getting rid of it altogether. And this is a massive deal because at the end of the day, can the U.S. keep spending without being in check? I don't know.
There are some strange things that I'm not sure we've bottomed yet about the way that this story is developing. And one of them is what President-elect Trump wants here. Does he want to extend it or does he want to scrap it? Because he seems to be arguing in different places for those two options. And also, you have to look at the 38 Republicans who voted against this. They want spending cuts, they say. But then Trump wants to have the ability to increase government debt. So I'm a little confused about fiscally what all of this adds up to.
I think you're in the right spot. I think we're all a little bit confused. Conservatives don't vote for getting rid of debt ceilings. That's why you have seen this fail in the House.
So the Republicans definitely, the Republicans, and you're already seeing comments coming through, the Republicans want spending cuts. Certainly a significant portion of them want spending cuts. This flies completely in the face of that. Just for everybody that's just getting up to speed on this, Donald Trump is also posting this morning. This is happening kind of in real time. You've got him talking about getting rid of the debt ceiling. You've got him talking about pushing it out to 2029. This is happening right now. This is our new world, folks.
This is new normal.
This is where we are now. This is going to happen in the middle of the night, U.S. time.
It's worth arguing the other side of it, just for the folks who are Team Trump here, in this idea that he's right, that getting rid of the debt ceiling altogether would make these federal shutdowns that keep happening every month, and certainly on an annual Christmas present kind of basis, way, way easier. But the point of putting the debt ceiling on in the first place over a century ago was the idea that when the Treasury needs to issue war bonds, pandemic stimulus, emergency measures, they can do that without the hustle and bustle of Congress. And that's where the debt ceiling comes in handy.
Internationally, it certainly got boring watching America go to the brink every 5 minutes and then come back from it, you know, shutdown after shutdown.
But
it's tedious.
The idea as well is that it's meant to contain U.S. debt.
But it keeps moving.
Which it hasn't. So you do wonder, actually, to your point about whether or not actually Trump has a point here, whether or not it serves any useful purpose. And that is something that maybe actually is a bigger consideration that we need to think about. He's also tweeting about what's happening here in Europe. You think about the market setup this morning. We've got him not tweeting, Xing, posting,
socialing.
He's truthing.
Whatever it's going to be.
Is there a verb there? I'm not sure.
I think the two may overlap, ultimately end up overlapping. But we find ourselves in a situation where you've got markets didn't bounce strongly yesterday. Equity markets did not bounce strongly yesterday post-Powell. And I think that's worth bearing in mind. So we go into this morning with the latest around what is happening in Washington. You've also got Trump posting on Europe, talking about tariffs all the way, if we don't buy significantly more gas. Are the markets set up for this kind of a story going forward? As I said just a moment ago, at the beginning of this week, we thought the Fed was going to be cutting, everything was going to be rosy, Trump was going to be benign, he was going to be transactional, we were going to be able to manage this narrative.
Things have changed. And what we're seeing then in terms of risk off, a little bit, US futures, European futures, is that all still central bank related because we've pulled back from higher expectations around rate cuts? Or is it to do with what President Trump is throwing into the mix on the debt ceiling, concerns around the US debt story, and then as we get to the European session, is it about what he's saying now about tariffs all the way on Europe? The markets don't seem to be paying too much attention to this, to your point, Kriti, a moment ago. But Derek Wallbank on the Markets Live blog making the point that that's a brave position to take, to not take the debt ceiling stuff seriously in the first instance, at least.
And it's one that hasn't played out, to your point, in the 30-year at all. And you've seen it, of course, so focused on the Fed, a 30-year at 472 right now. And for the record, this is the dislocation back in, I think, the third quarter of 2023 that saw such a spike because, again, I think it was in the context of a shutdown. The BOE talked about it. The BOJ talked about it. This has international repercussions if you start to see the bond market have to play catch-up at the end of the day.
A couple of levels to watch out for this morning. 59.26 is where we are now on E-mini futures. 59.06 was the lows we got to post-Powell. If you get below that, technically that may signal further selling coming through on the equity story. Watch out for that a little bit later on. You bring up the inflation narrative. We get PCE data a little bit later on as well. That's going to be something that we're all going to have to pay attention to. The Bank of England yesterday, I'm trying to figure it out. What actually was said by the Bank of England? What message should we take away from it?
Well, the conclusion of our colleagues in Bloomberg News seems to be what you were saying yesterday, Guy, that there was an opportunity, even without a press conference, to push back against market expectations of fewer rate cuts in 2025. And then we sort of levelled our expectations, saying, well, brought down our expectations, saying, well, maybe they won't do that because there's no press conference. So how are they going to push back against that? But that seems to be some of the write-ups that we've seen, reiterating gradual cuts, the fact that there were 3 dissenters, not 1, all of that seems to be adding up to, in the market's eyes, some pushback against our lower rate cuts expectations, which since September, as you can see on that chart, we've been dialing back our expectations for how much cutting we'll get from the Bank of England since September. And so maybe this is the BOE pushing back on that a little bit. We add into the mix some data this morning, up 0.2%. This is a volume measure, remember, on retail sales, including auto fuels, etc. That's not quite as good as expected, but it is volume, not price.
The consumer's certainly feeling it post the budget. I think there certainly seems to have been an impact post the budget. I remember sitting down with the governor after a meeting, and we were talking about signalling mechanisms, and he said, I'm really surprised that the market hasn't latched on to the message we were sending via the vote count. And it was clear that he made it explicitly clear that they used this as a mechanism.
There it was
to send a message. And I just wonder whether that was what was delivered yesterday. Here is a message via the vote, to your point, via the vote counts, to say that actually we're not as hawkish as maybe the market.
Especially when we had wages so hot and parts of the inflation story were hot, services, for example. But, Guy, we need to get to the rest of the show.
What are we going to talk about throughout the rest of the show? We've got some great guests to factor this all into the markets this morning for us. Melanie Baker, Royal London Asset Management Senior Economist, is joining us around the table. Andre Kelleners, Goldman Sachs partner in the Global M&A team, talking to us a little bit later. What does 2025 bring on that front? Deregulation, is Trump going to be good for M&A? That was the idea when he was voted in. Does that still hold water? Henry Allen, Deutsche Bank research macro strategist. Ludwig Subran, Allianz chief economist, joining us a little bit later on. We've got a lot to think about this morning, both from a US point of view and a European point of view. How does it all fit together, Kriti?
Yeah, and of course we're counting down to that US data point. There's still more, believe it or not. We're not quite ready for the holidays just yet. US PCE coming out at 1:30 p.m. UK time. An hour before that, though, Mary Daly is going to be joining Bloomberg Television, maybe talking a little bit about this inflation story as well. But then tonight, it's the big story over in the States, that US government budget deadline, I believe about 22 hours and counting now until the U.S. government shuts down.
I'll put my cup down. What else do you need to know this morning?
We've had a lot to say already.
Yeah, precisely. Anyway, French Prime Minister François Bayrou is aiming to present a new cabinet over the weekend, so we'll talk about that Monday, and deliver a budget by mid-February. Appointed Premier last week, he is under pressure to move quickly and pass a spending bill aimed at putting the country's finances back in order. In an effort to soften opposition to such a finance bill, Bayrou says he is open to unwinding Macron's pension reform, but ruled out suspending its application. FedEx soaring in in After Hours. This after the company announced a plan to spin off its $30 billion freight unit into a separately listed company. And it's going to do that in the next 18 months. The spin-off will allow FedEx to focus on its core business and would boost its underwhelming stock performance by capitalising on rising valuations of standalone trucking companies. We'll talk about M&A a little bit later on. And the union representing Starbucks baristas is set to begin a 5-day strike across stores in Los Angeles, Chicago and Seattle. The group says the decision comes after the coffee chain presented a package that offered no immediate pay rises for baristas. The union expects these strikes to spread to hundreds of stores by Christmas Eve. Meanwhile, Amazon, the Teamsters, has launched its biggest effort yet, asking workers to walk off the job at 7 Amazon facilities where the union has previously sought to represent the company's contract delivery drivers or warehouse workers. No coffee for Christmas.
I guess not. At Amazon, at Starbucks, at Volkswagen potentially, if these deal talks don't go through. The timing is crucial here, though. I wonder if the labor momentum that a lot of these unions have or have had in 2024 and 2023 even continues into 2025 or accelerates if we see these inflation expectations building.
Right. Well, it's been a feature of a strong labour market, hasn't it? And a tight labour market, that Labour has more power. And we've maybe seen that play out. But are they mismatched now? Because are we going to see a different story developing in the labour market?
The Fed basically has said we're not worried about the labour market anymore. That was the message that was delivered by Powell earlier on this week. Firmly focused back on inflation. The labour market seems to be taking care of itself. The GDP numbers look really strong. Employment looks really strong right now. What have we got to worry about in the labour market? And this is just another symptom of what we're seeing there. Labour feels like it has the option to present its power to management, and we're seeing it across the board, as you say, Kriti.
Yeah, we're seeing it and I think what's interesting, it's not just in the wages story, it's in the benefit story as well, right? It's medical benefits, it's pensions, it's also things like promotions, healthcare insurance is, of course, a very big hot topic right now in the United States and globally, just given the news. I don't know how much maneuverability there is, though, because last time we had this labor momentum, corporate earnings were strong, profits were strong, everything was rallying, and now you're starting to see cracks on corporate lines, and I just feel like maybe companies don't have as much to offer as maybe they did 2 years ago.
You're seeing it in offices as well. So everybody wants to go to nice offices. Nobody wants to go to nasty offices. Basically, you want me to come back to work? You want me to come back to work in an office? It's got to be a nice office. Yeah. It's manifesting itself in a number of different ways.
It certainly is. Coming up on the programme, we'll get back to some of the other corporate earnings stories we've been dealing with overnight. Adidas in focus after Nike's muted short-term outlook. Plus, Trump looms larger over Brussels. We'll head out to the European Council to hear how leaders on the continent are adjusting to the incoming commander-in-chief. As we've mentioned, President-elect Trump has been busy already this morning talking about the potential for tariffs in Europe. Up next, we're capping a big week of central banks with the Bank of England vowing to not be swayed by the noise. More on that next. If you have any questions, if you want to get involved in our conversations, IB plus BBTV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher.
In order to reach a decision on the next rate hike, I would like to see another notch, although it might not be the most accurate way to put it. I think the sustainability of wage growth will be one of those.
The path is downwards. But I really would caution that at this stage, with the amount of uncertainty, we can't tell you by how much, or when particular moves are going to take place. It really is, the world is too uncertain. So we will, we'll come back in February at our next meeting and review it again.
Hawkish, dovish. Fed, BOJ, Bank of England. Bank of England, the surprise in so many ways. 3 big central banks delivering decisions this week. The Fed certainly delivering a surprise. The Bank of England delivering a surprise. Maybe the BOJ didn't. Longer-dated US Treasuries weakening a little bit, causing the yield curve to steepen to a level last seen 30 years ago. Let's get into the details of what is happening here. Valerie's going to walk us through what we're seeing.
Yeah, in yesterday's session, Guy, there was a little bit of revaluation in the front end. We saw at one point the two-year yields rally, taking out nearly half of the rise since the Fed decision, that hawkish Fed decision 2 days ago. However, what was more pronounced was the weakness in the long end, which I want to hover on for a bit, because it caused the 2s-10s curve to steepen, the biggest one-day move steeper for the 2s-10s curve that we've seen this year. We had a continuation of yields rising in the long end. Some of that exacerbated by the fact we heard from Trump, or reports that Trump would be a fan of scrapping the debt ceiling and more fiscal spending. The easier track to push fiscal spending is clearly negative for the long end. So we have seen those 30-year yields creep higher as well. What we also did see a continuation is the equity market weakness. We had the S&P 500 close in the red now for 3 days running. Also, the looming government shutdown having an effect on the equity market today. We're now in the red. But the one thing that could maybe have a bit of a bright shine on the equity market is the PCE data coming later today at 1:30 UK time. The market doesn't expect this print to come in soft. Have your eye on the core PCE month-on-month figure. If we do get a soft print on this, Guy, maybe it could help the equity market close in the green this Friday.
Valerie, thank you very much indeed. Joining us around the table, Melanie Baker, Senior Economist at Royal London Asset Management. Good morning. What's changed this week?
There's quite a bit going on this week, isn't there? So, I mean, yeah, we did have some different messaging, a bit of a shift in messaging from some of those central banks. I think a general message of caution from all three of those major central banks, even if they mean something slightly different.
Because they don't know?
There's a lot of uncertainty. So just as we're looking at all this news coming through and trying to digest a lot, we've got additional uncertainty being injected overnight from Trump. Central banks are kind of feeling the same thing, I think. Again, different things for different central banks. There's an awful lot of uncertainty they have to wade through.
Powell talks about kind of being in a room with lots of furniture and smoke and all kinds of other things. Basically, you can't see what's going on. Is the easiest thing for central banks just to park it for now and wait and see? I
wouldn't say park it for now, but I'd say tread cautiously. So, you know, when there's a lot of uncertainty, it makes sense just to go a little bit slower and a little bit more carefully, perhaps, than you might otherwise like. And that goes, I think, for all three of those central banks that we've talked about.
Yep.
Can I just home in a little on the fiscal story in the US then, Melanie, and what we understand about it and what we don't? Because clearly there's a lot of uncertainty in the short term as to what happens with this shutdown looming. And then we think about President-elect Trump and what he means on debt. And on the one hand, he's surrounded by people who want less spending and lower debt levels, and lots of Republicans want lower debt levels, as we were discussing at the beginning. But then at the same time, he's talking about removing the debt ceiling. Do you do that because you want to increase debt, or do you do that just to stop us having to go through this sort of charade of being up against the debt ceiling all the time and then increasing it? I mean, what do we know and not know about his fiscal intentions in 2025?
There's an awful lot we don't know. So I think on the debt ceiling, I'm hoping it's the latter. This is about just getting rid of this kind of ridiculous sort of brinkmanship that we have regularly in the US, and this sort of event risk every time. But in terms of his overall fiscal intentions, he's made a lot of tax cut promises. However, we've then got a lot of what it seems like spending cut promises now, with sort of Musk going into this kind of government efficiency role as well. So while it looked in sort of the build-up to the election, we're going to have actually quite a loose fiscal stance from Trump coming through, given the sort of tax cut promises upon tax cut promises. It's a little less clear, I think, now how that balance is actually going to work out.
And where does and obviously the Fed then in a room full of furniture and on a dark, foggy coast and lacking visibility on all these fronts. But when you look at the policies that we do have some sense of, I mean, how much inflation are you expecting the Trump presidency to sort of add into the mix?
Yeah, so I'm assuming that the combination of his policies on immigration, on tariffs and on the fiscal side will be inflationary. I put in a few tenths extra inflation into my forecast for next year, but I put pretty wide bands around that. And a lot depends not just on how far he goes with all these promises, but of course on the timing, on the sequencing of these things.
Yes, because a lot of people say if tariffs comes early, that's pretty risk off. But if tariffs is just a threat that sort of lingers for a long time and isn't really acted on as radically as it could be and doesn't come until a lot later, then that's going to be less negative.
Yeah, exactly right. That's a huge range of uncertainty that's just been outlined there. I'm assuming we have to take him seriously on tariffs, and particularly those promises around additional tariffs on China and across-the-board tariffs on everybody. But there's a question around how far that goes.
Well, Melanie, I feel like everyone's on this wait-and-see approach in terms of, to your point, seeing what comes through. But does that do more damage? Does the waiting do more damage than the actual eventual result? And to what extent?
I mean, that's a good question. If a central bank needs to do something, they should just get on and do it. And the one perhaps I worry about most there might actually be more the Bank of England, where I think it would be great if they had more room and more scope to cut right now and speed up the pace. But given their own domestic inflation backdrop in the UK, that's actually quite difficult to do. But certainly some warning signs appearing in some of the sort of business survey data in the UK.
You're seeing it in other parts of Europe as well, right? In France, for example, the business optimism survey was tanking, not because of any economic fundamentals, but because of the political uncertainty there. And I'm curious what the solution to that is. I mean, besides get your fiscal orders in place, but is there a way to almost offset those worries and offset that lack of confidence in other ways? Government subsidies, tax decreases, whatever that may be.
I mean, part of the uncertainty is around the fiscal outlook, unfortunately, for France. But I mean, other countries can do things. So in Germany, we have an election coming up. It'll be interesting to see whether we get any relaxation in the debt brake, for example. And that could be quite a game changer, possibly, for the European sort of narrative and story. We've got those Draghi reforms. Can they make progress there? And then monetary policy. And I'm expecting more rate cuts from the ECB, which will be helpful as well.
You mentioned the German debt brake. What actually happens? If it's removed, hypothetically, down the line in 2025 or further on, what actually happens besides this very positive story that it would incentivize investment? What's the negative to that?
I mean, it could be politically quite difficult to get through. I'm not sure how that would be played upon by some of the non-mainstream parties in Germany. Economically, this is something I think that probably needs to happen. It would be great for Germany to have that bit of additional fiscal flexibility. It's a country that do have space and room to engage in more fiscal spending and more investment. I think that would be a good thing on balance for the euro area.
If it's tariffs all the way, which is what Trump is signalling, if we don't buy enough gas, oil, whatever it is, to balance out everything, what is the response to that in Europe? Is it reciprocal tariffs? Is it lowering the currency? Is it significant rate cuts? How do you think that menu of responses is going to occur, and how coordinated and effective do you think it could be?
That's an interesting question. I'm assuming that they're preparing a range of ways to respond, and some of that will be around retaliatory tariffs. But also there's presumably a willingness to engage as well. If you look at the language of that message from Trump, there is he sees a sort of deal to be done there.
Right.
It's not.
So are we still in the transactional camp? We can still see a transactional Trump being something that we can work with?
I can still see a transactional Trump, absolutely. The one thing I worry about underneath that is his threat to impose across-the-board tariffs. So that might still come in on top of those additional tariff threats aimed at more specific countries.
Melanie, great to see you. Thanks very much indeed. Yeah, precisely. We'll wait and see. Melanie Baker, Senior Economist at Royal London Asset Management. Thank you very much indeed.
Yeah, a fascinating one. She's talking about the financing condition, she's talking about the debt brake. Maybe there's a little bit to be said about what that means for the likes of M&A, especially when you're starting to see some of the capital markets tick up just a little bit. That's what we're going to be talking about next. Is 2025 going to be the year of M&A? We've certainly seen plenty of examples right here in Europe when it comes to the banking sector, even when it comes to things like chemical companies and sovereign wealth funds. That was the story I just read in terms of Covestro and getting the financial deals in line. We're certainly seeing in terms of the FedEx spinoff. All of that may be a positive. At least that's what Goldman Sachs is predicting in terms of a significant upside potential for deal making next year. Our interview with the bank's global M&A partner coming up next. Stick with us. This is Bloomberg. Minutes away from the start of the opening trade across Europe. When you look at futures pictures, though, it is a sea of red. Some real underperformance from the Eurostoxx 50. You look at France and Germany, and that's where the majority, it feels like, of the pain is going to be kind of concentrated. When you look at the FTSE 100, though, not the same amount of pain, Anna. Flat, where the Eurostoxx 50 down a whopping 0.7% in terms of the futures picture.
Yes, is this something to do with the handover from the US yesterday, where we saw a bit of weakness coming through and the session got worse and worse, I suppose, in the US? Is it that sentiment driving things? Well, things are getting cheaper. Is that material for people's appetite for M&A? A flurry of deal-making activity recently has excited markets, with interest rates coming down and Donald Trump vowing to gut regulation in some areas. Some are predicting a big year for M&A. Goldman Sachs is expecting, quote, significant upside potential for deal-making next year. To discuss the outlook, we're joined now by the bank's global M&A team partner, Andre Kelleners. Very nice to have you with us, Andre. Thank you for coming in to speak to us. So I suppose your outlook for M&A globally, broadly, is pretty buoyant. How does that withstand tighter monetary policy, I suppose, is my first question. If we've learned something this week, it's that maybe we don't get as many global rate cuts as we thought we might, unless you took something different away. How does that trend toward more M&A stand up to that?
Yeah, I think it's easy to forget how uncertain the world was a year ago when we got into this year, when there was significant uncertainty about interest rates, economic trajectory, and the overall outlook in the world. And even though there will always be some degree of uncertainty about monetary policy on a go forward, people feel pretty good right now about being able to predict it within a band, and that provides a level of stability that allows buyers and sellers to price assets in different markets, and that's been benefiting the M&A market as well. OK, so in terms of some of the themes that you see driving M&A next year, separation or simplification of certain businesses is one of those. We had an interesting example, FedEx overnight, talking about spinning off part of its business, the freight side of it. Tell us what's driving this particular trend. Is this about getting better valuations for much more niche areas of business? It's really coming from investors and corporates and boards. It's corporates and boards want to be fit for purpose in a very competitive world. There's a view, particularly among the investors as well, that focus helps drive performance. And so they look at their portfolios and they look at areas of their portfolios that aren't quite within the core of the business, and they want to focus on the core and driving that part of the business. And so we've seen a huge trend in simplification in the world more globally, but particularly in Europe this year, it's been a real uplift.
You say that there may be a significant pickup in capital markets activity. You've seen a little bit, to be fair. You've certainly seen plenty of takeover offers and banking consolidation as one example among many others in Europe and abroad. But it's still not quite at the point where, say, private equity players are saying this is a juicy market to IPO. There is still that glut. What gets us from the glut of deals on the sidelines to a thriving capital market?
Yeah, we've really seen the focus sort of come back throughout the year. It was harder at the beginning of the year for any buyer and seller of financial assets to really find price, whether that was in the IPO market or in the private equity market. And throughout the progression of the year, we've seen fingertips being able to meet on price again, and financial investors have started buying and selling assets among each other again. And it's really been unlocking a dynamic that's been causing lower volumes on the back of the volatility in 22 and 23. Where now you see a more stable environment again. You see buyers coming back into the market, less opportunistic, more forward-leaning into selling and monetizing assets again. That's gradually come back. We think that's got more room to run in the course of next year. And that's going to be a big part of driving PE activity.
Is there a change in the way some of those deals are financed, though? So, for example, a lot of the banking deals that we're looking at in this region have been financed by cash, extra cash on balance sheets, profits, trading profits that are financing some of that. Is there a way that deals may be done where you take on more debt or you issue more stock as a way of financing some of those acquisitions or separations?
Yeah, corporate cash balance have been at records high, and so cash is always the least expensive means of financing a deal, and that's always going to be there. I think that debt markets are very robust. Debt markets are very supportive of deal activity, both for private equity transactions and for corporate deal making. And so we do think that will continue to be a very meaningful component of financing. But with less volatility in the equity markets, maybe the last day or two aside, stock has also been an easier currency to price again, and so buyers have been more forward-leaning as equity markets been up for 2 years to use their currency and the equity currency in transactions.
Do you worry that we're at peak confidence, though? Like we may be in peak markets. Are we peak confidence?
Look, it won't be linear for sure.
How much volatility? Huh? How much confidence volatility are we going to see? How big are the swings potentially going to be, and people's ability to predict the future and be confident that they can deliver in the future?
I think, look, confidence will always be something that's going to ebb and flow a little bit with the news of the day. So It won't be linear. We do think the market has room to run. If you look at M&A as percentage of market capitalization over a long period of time, we're still at a record low. We've come off in overall volumes by 18% from last year. But we do think the cycle has room to run. It'll be a multi-year process and over the next coming years. But we do think our clients at the moment feel very good about the outlook. They feel that the economic trajectory is more predictable. Commodity prices have been more stable. Rates are more stable. Markets have been up. And so that's driving a more forward-leaning perspective.
Do we need rate cuts or do we just need rate stability?
I think rate stability will be good enough.
Okay. That's good enough. That's interesting. And what about, we talked a bit about where we might see this in Europe. I mean, the banking sector has been talked about in Europe as overbanked in certain geographies, and there's a lot of noise around certain, individual banks. But do you see the conditions for consolidation within the banking sector in Europe to really get off the ground? I mean, what are you hearing when you talk to people, Andre?
Well, I mean, there's been some activity in that regard in Europe this year so far. We do think there's a benefit in consolidation in Europe. The conditions may be improving just because there's a recognition that consolidation will benefit the sector overall in Europe. It remains very fragmented when you compare it to other parts of the world. And obviously, it's a meaningfully regulated industry. And so there's going to be support for more to do. And if that's the case, then I think we will also see more.
But do political voices and regulatory concerns that politicians might have, or just domestic nationalistic concerns, whatever is motivating it, do they stand in the way of getting those kind of deals done? Do you still think?
I don't know. I don't know if it's I'm not sure that's necessarily the case, but it's certainly an industry that has more room to grow from a consolidation perspective in Europe. And I think the region more broadly will benefit from having strong banks and strong financial institutions more broadly.
Can we talk about consumer companies for a moment? This is your area of expertise among many. There's a thought that there may be consolidation if you see a surge in things like obesity drugs or other kind of really hot products in the consumer sector at the moment. Could you see some sort of increase in that sector specifically?
Yeah, it's a sector that's gone through a lot of sort of different dynamics and trends over the years. When you think about social media has lowered almost of the barrier of entry, so it's made it easier for up-and-coming brands to compete with more established brands. When TV advertising gives way to social media, the obesity drugs certainly have been an interesting trend for companies in the space. And then, of course, the consumer complex more broadly has also been impacted by inflation in input costs and in the ability to pass it on in pricing.
Yeah.
And how that balance is going to shake out is going to meaningfully play a role in consolidation in the sector. To the extent you'll see pressure on top lines in a sector that really benefits from compounding growth, you might see consolidation as the alternative tool in the toolkit.
Where's cheap? Are we going to see de-equitization continuing in London? We're going to talk about that a little bit later on. Are European valuations making M&A attractive in this part of the world? Which areas do you think are going to be the biggest area of focus, 2025?
Well, financial buyers have been very active in Europe this year. They've been particularly active in the UK. 40% of all buying this year has happened in the UK by financial sponsors.
Yep.
And the other trend that we observe is take privates, public-to-private transactions, so financial buyers buying public companies in the public market has been continuously on the rise since 2015 almost.
And that continues next year, both of those two trends?
We do believe that will continue. About a quarter of all buying that sponsors are doing right now is happening in the public markets. And that's up from 5% in 2015. So it's been a continuous rise. It's always been a little bit higher in the US, but sponsors here are getting more and more comfortable with the process of buying public companies as well and what's entailed in various jurisdictions around the region more broadly. And so it's broadening out from the UK onto the continent as well.
Andre, thanks for coming to see us. Really appreciate it.
Thank you for having me.
Andre Kelleners, partner in the Global M&A team, joining us from Goldman Sachs. Coming up, we're going to take a closer look at European delivery stocks ahead of the opening trade. This after FedEx cuts its full-year profit forecast due to weak demand. Looks like we're getting a Nike read across into Adidas as well. We'll focus on those next. This is Bloomberg.
Welcome back to the opening trade. We still have 17 minutes or so until the start of trading here in Europe. And given the handover from the US yesterday, looks as if we'll have some weakness at the start of trade. And US futures look a little weaker. Nasdaq futures down by around 0.5% this morning. Let's bring into the conversation for a markets thought from Ven Ram, Bloomberg Markets Live cross-asset strategist, who's with us this morning. And Ven, I want to start with what's going on in gilt markets, because since September, we seem to have been pulling back our expectations for how many rate cuts we get from the Bank of England, in keeping perhaps to some degree with the Fed conversation as well. But the Bank of England maybe didn't like that too much, and we've got some pushback, some dovishness from the BOE yesterday. Was that interpretation correct, and is that going to stick with markets?
Morning, Anna. I don't know if it's going to stick with the markets for the simple reason. The markets are worried about one thing pertinently, which is inflation. The inflation bogey is running amok in the markets, and nothing that the BOE is signaling seems to have had any effect. We saw the dovish tilt yesterday from the Bank of England. We got 3 members opting for a rate cut, and Bailey also reiterated his message for gradual rate cuts, i.e. for the earlier guidance that he had given for 2025. But look at the reaction in gilts. Gilts have gone nowhere, and yields have surged in the past month. Why is that so? Why are the markets reluctant to buy the BOE story? If you look at the 2-year inflation break-evens, the message is right there. The 2-year inflation break-even is at 3.25. So the market's estimate, best estimate of inflation, is that it's going to overshoot 3%. And if you add on a neutral rate of 1 to 125 basis points, you will get a BOE rate of 425 to 475, which is why the markets are refusing to price more than 2 rate cuts. And that is going to hold back any rally in gilts, which is why the short-term outlook for gilts is not very constructive.
Ben, let's look at the U.S. Treasury market as well, of course, in the context of the news we got this morning that a federal deficit is looming, a federal shutdown is looming. What does that do to the Treasury market? Give us a floor, give us a yield ceiling.
Well, if you look at, we have seen this movie play out before, Kriti, in 2018, 2019. The markets were shut between December 22 and January 18th, I think, if my memory serves right. And during that period, 2-year yields nudged lower by 5 basis points. 10-year yields did similar as well. So, look, this is a shutdown as opposed to a debt ceiling impasse. So I don't think there's going to be undue turbulence in the market. But of course, one has to keep in mind the thin liquidity that prevails during the year end. But looking beyond that is the outlook for treasuries. If you look at the neutral rate that the Fed has penciled in, they've successively raised that neutral rate, mind you, and they have now penciled in a rate of 1%. Now, Fed speakers have suggested that this may be as high as 260 basis points. That's phenomenal. That's just the real neutral rate. And if you add the core PCE of 270, today we are going to get the number that is expected to show 290. What you get is a Fed funds rate well above 4%, and which is why the 10-year Treasury yield is also sticking above stubbornly around 450. Kriti?
We'll wrap it up there, Ven. Thank you very much indeed. Ven Ram, Bloomberg MLive cross-asset strategist, joining us. Remember, we've got MLive Go on your Bloomberg terminal. Let's talk about one of the deals we're going to be watching going into the US Open maybe a little bit later on. Boeing has won an order valued at $36 billion. That's the list price from Pegasus Airlines out of Turkey, the biggest commitment so far this year for the OEM. It steals a blow to rival Airbus, previously the preferred choice for this Turkish low-cost carrier. For the latest, we go to Benedict Camel, who leads our aviation coverage. Benny, they're buying MAX 10s, which hasn't even been certified yet. And obviously this is an aircraft that is going to be delivered some way down the road for Pegasus. How good a deal do you think they've got? How good a deal that have they negotiated with Boeing here? I'm assuming it must be sensational.
Yes, I think you're absolutely right. And I'll be honest, when I saw these headlines cross yesterday, it was a bit of a head-scratcher to me because this is an airline that had moved solidly into the Airbus camp. I remember sitting down with the CEO not so long ago, and I pointed out, look, you've got a couple of leftover 737s in your fleet, but mainly you're an Airbus fleet. And she said, yeah, we really want to become an all-Airbus fleet on the narrow bodies. We're going to sort of sweat out those remaining 737s, and that'll be that. And we still have more aircraft aircraft pending from Airbus. So for them to go the other way, that was a big surprise, and it points to what you were suggesting, that they must have gotten a very, very good deal on this. This is an aircraft that's not flying yet. I mean, not publicly. You and I, we've seen it fly at air shows, but it's not flying publicly yet. It's not certified yet. So it's something of a bet into the future that that plane will come to fruition, and they must have gotten a very good deal. It's a good question whether that timeline that they have in mind, 2028, whether that's too optimistic. This is a plane that's been delayed continuously, so whether 28 is a doable target, that'll be very interesting to see.
What does it tell us about the state of play in Seattle at Everett in terms of manufacturing aircraft? They're back, they're manufacturing. What does it tell us about the need for them to just deliver some orders at the moment, to deliver some good news?
Yeah, that's exactly what they need to do. And if you look at the stock price, it has sort of enjoyed a bit of a bounce in the last couple of weeks. It's come off those really terrible lows that it had throughout the year. Since November, we've had a couple of really good pieces of news. The strike ended. They got their financing in order. People generally are buying into Kelly Ortberg's strategy. That's the new CEO. They think that he's got a handle on it, but there's a lot of work ahead. So to your point, 2025 is all about execution, is getting that production rate back up. They want to get back to 38 on the 737 a month. They're really far away from that at this point. So getting there, even by the middle of next year, that's going to be a tough order. They've only just restarted production of aircraft after the strike, and that'll take a while. Kelly Ortberg did say, you know, turning things off is much easier than turning them back on again. Things are out of position. People are out of position. Some people need to be recertified and retrained. All of those things will take time. And then you have these massive orders that you need to fulfill. So on the one hand, that's nice to have. You have all these orders, but you actually have to pump them out and get them to customers.
All right. Benedict Campbell, who leads our aviation coverage globally, joining us this morning out of Berlin. We thank you so much for breaking down that deal for us. Let's go and get our stocks to watch 10 minutes away to the opening trade. Joe Easton has that for us. Joe.
Morning, Kriti. So we got a big jump in FedEx shares last night. It was kind of a bit of a mixed report, actually. Their guidance for the year ahead was actually a little bit weaker than expected, even after their quarterly results actually beat expectations. They also announced a big spin-off of their freight division, so it's difficult to kind of say which elements drove the stock higher, but we will be watching the usual shares here in Europe, including DHL, also IDS, the owner of Royal Mail, and a couple of the other ones, PostNL and bpost. There is a note out from JP Morgan saying the parcel business of FedEx does look to be a positive read-through for DHL this morning. Then in terms of the sportswear, the other big read across from the US, we had numbers out of Nike, and actually pretty downbeat. We saw a jump in Nike in the after hours at first, and then it came right back down and was in a minor positive territory. The company predicting a double-digit decline in their revenue on the quarter, and that is bigger than the around 7.7% downside they had predicted previously. Now, interestingly, this is potentially positive for Adidas because Adidas is seen to grow its market share as Nike actually loses out. So that could be positive there. But on the negative side, you would want to keep an eye on JD Sports, which is a big Nike retailer. So it's seen as a bit of a negative one there. Puma and Fraser's Group, JD Sports, the other one to keep an eye on in that area as well. Then in terms of drugs, we've got a disappointing update from Zealand Pharma in obesity. One of their big obesity drugs not looking like it's going to get FDA approval for now. And analysts over at Bloomberg Intelligence calling this a surprising setback because they had said that this would be a potential blockbuster drug in the weight loss space. Zealand Pharma has, of course, doubled in value this year in terms of the shares, alongside the big rally we've seen in Novo Nordisk and Eli Lilly in the US. There's that big rally on the screen there, potentially some downside in that one. Then finally, on ratings changes, a couple to bring you today. BE Semi, that's a new top pick over at Morgan Stanley. JP Morgan, meanwhile, upgrades Fraport, the Frankfurt Airport Company, and Segro here in the UK. That one is raised to buy at Citi this morning.
Thank you, Joe. Joe Easton with a look at some of the individual stock names. And it's really interesting looking at the drivers of markets over the last 24 hours or so. And futures are suggesting will be weaker at the start of trade here in Europe and then into the US session as well. Guy, you made the point earlier, the handover from the States is pretty negative when you look at where the session ended there. And then you add into the mix the fact that President-elect Trump has been up early in our hours, European hours, up late probably for him, talking about the need for tariffs on Europe. That didn't seem to weigh too much on the futures story. French politics in the mix as well, a lot of flux there and resetting our expectations around when we get the budget. Basically, we're weaker and it's hard to know pinpoint exactly why.
Yeah, I kind of want to know why he's truthing. I'm going to say truthing at 1 in the morning around this, but certainly not enough to shake the markets in a way that I think maybe if this happened 4 years ago, maybe the markets would have reacted. Is everyone just gearing up for the holidays? Are we all just kind of liquidating and saying, we'll figure this out in January?
I don't know. It's surprising that we haven't seen more of a reaction, I think, on the tariffs all the way line. Maybe we're just getting... Maybe actually, though, this is confirmation of the transactional nature of this.
Yeah.
You deliver this, we don't get this. You don't deliver this, we do get this. This does feel like actually a fairly transactional post, let's call it a post. And I wonder whether that is a confirmation of what Europe hopes for, i.e. this can be negotiated.
The one place I feel like you are seeing the market move is in the natural gas space. And I'm wondering if that's just, he did comment as part of his barrage of comments around the debt ceiling and the extension. He also made the comment that if Europe doesn't buy more nat gas/oil, there would be tariffs coming down the way. You are seeing natural gas over in the States and the Dutch contracts as well, higher by about 3% this morning.
It is up a little bit, isn't it? And then it takes you back. We'll have one of our colleagues on to sort of unpack the commodity story here. But to the point about how transactional it is, you wonder if that's a red herring. That's the part of the conversation. These are the links that President-elect Trump is making. But is that really the story? What does he want to see in exchange for not putting those tariffs on? We'll see.
Got PCE later as well. Let's fold that into the conversation too. Some more inflation data coming out of the United States. Really strong GDP data being delivered yesterday in terms of where that economy is right now. Super strong, super strong. And you wonder whether that is going to continue. We'll watch what is happening in Washington, D.C. We'll factor it all into the opening trade. That is coming up next. This is Bloomberg. Friday morning, good morning. A couple of minutes to go until the opening trade here in Europe. There is so much to fold into this opening session that I think it's going to be fascinating to see what we focus on, what we don't focus on. There's a lot of Trump posts out there at the moment that we need to fold into the narrative this morning. You've got Nike, you've got all kinds of things that you need to be thinking about more broadly into this market. What does FedEx do to the European transport sector as well? This is the picture from yesterday. The US market faded into the close. We've got that maybe to price in as well. But this week, so much seems to have changed. We get to the end of the week trying to figure out where we are. I think our heads are still spinning. What do we see in futures?
Well, a sea of red is what you're seeing here. Your Stocks 50 futures down 0.8%. But by comparison, the FTSE 100 is not tanking this morning. And it's that gap that I think is really interesting. It might just be a sum of all parts, though. And especially when you look at where most of the pain is concentrated, and that is in the DAX story. We've got a couple of movers I know you've got your eye on as well. But futures showing 0.9% of a decline in the German index.
Yeah, it's something negative in Germany and France today, it would seem. Certainly that's what the futures are indicating. Let's go to some of the individual themes that you guys have been referencing. What will we make in the delivery stocks? So the likes of DHL in focus, Kuehne & Nagel over in Switzerland. We'll watch those because, yes, FedEx rose on the back of an asset sale plan. But underlying that, their guidance around the way that business is performing, the express business and other parts of their core business was a bit more negative. So we'll watch that. On sportswear, we've had the read across from Nike. So we'll keep an eye on Adidas and Puma. So those will be in focus. And Zealand Pharma is an interesting one to watch. So they got a complete response letter from the US FDA on the company's new drug application for glepaglutide. They're so hard to say. We'll watch to see if the market reacts to that one, Guy.
We will look forward to that. Let's talk about the market open. Let's figure out exactly what is going on here. It is time for the opening trade this Friday. Wow, what a week it has been. Here we go. Let's see what numbers are getting posted first thing this morning. The FTSE 100 a little bit weaker, but to Kriti's point, maybe actually it delivers a better story at the get-go this morning than we see in markets like, say, the DAX, where it does seem we are going to see some more significant weakness, but it'll take the DAX a little while to get going. So the FTSE's down by 0.2%, the 600's down by 0.3%, the IBEX is down by 0.6%. We are seeing weakness. What is interesting is we haven't seen significant weakness off the Trump posts, suggesting that maybe it's tariffs all the way if we don't see Europe buying more oil and gas out of the United States. But you've also got the chaos in Washington to factor into your thinking as well. We didn't see that one coming at the beginning of this week. We didn't see a hawkish Fed. There's so much that we didn't know at the beginning of this week that we now know. Have the markets repositioned enough for all of this information, or is it going to take time and maybe some lighter volume to get some bigger moves around what we are seeing right now? Anyway, there's the CAC. It is down by 7/10, 8/10%. I'll split the difference. But wait and see what the DAX does in a few minutes' time. Kriti, below the surface.
Below the surface, it's a sea of red, as I said. You are seeing some of the commodity names actually underperform over in the UK, which I thought was interesting. Rio Tinto, BP, Glencore. I'm not seeing Shell in that mix, though, and that might simply be because Shell does have that exposure to the nat gas business. So if you are seeing nat gas futures up, or excuse me, contracts up in the commodity market, maybe that's having a little bit of a read-through. I'm still waiting for that to shake out. But net, it's the red you see on the screen that I think is worth paying attention to, Anna. It might simply just be a function of a little bit of tech underperformance, ASML and SAP dragging down the market.
It does seem pretty indiscriminate, though, doesn't it? I mean, sure, there's some variation between the sectors, but they're all in the red. Travel and leisure is the only one that's not down by 0.5% or more in terms of the sector performance there. That's being lifted by some of the airline and hotels names, in fact. But the underlying message from this market this morning is just a red message, isn't it? It's all negative. Financial services is the worst performing sector. Construction and materials, basic resources, you mentioned, Kriti, all of those down by more than 1% on today's session.
And we should just look at some of these movers as well. Your biggest underperformer is UBS, down about 1.6%. They have a report coming out from the regulatory authority, reported to come out later today, where they're going to be investigating basically the kind of fallout of the Credit Suisse story and how many capital market requirements UBS actually needs to hold on to. The reason this is important is because Switzerland, and as a function, UBS, has had stronger requirements in terms of lending capabilities and that reserve ratio relative to some of its global peers. And that every time those headlines come out, UBS stock has moved. Perhaps that is weighing, at least in anticipation of that report, if it were to come out, down about 1.7%. There's a lot going on in these markets, but net, red on the screen. Let's bring in a true expert here. Henry Allen, macro strategist over at Deutsche Bank Research, joins us around the table this morning. I want to ask you about the cleanup at UBS, but I will ask you perhaps about what do you do in the sea of red? Is this, when you see Europe underperforming like this, at what point do you say, that's cheap, let's buy?
Well, I think there's a real opportunity in Europe as we look forward to the next year, because there has been this narrative of US exceptionalism. The US is going to do really well, and that's meant growth expectations have been upgraded considerably. But unlike 2023 or 2024, growth is now expected to be pretty decent in the US next year. So it's going to be harder to get that sort of upside surprise that has meant we've seen the relentless equity rally that we have. Whereas in Europe, expectations are still pretty weak, all things considered. But, you could make a case that there is some upside there potentially. You've got the fact that measures like bank lending survey are looking more positive. You may have the chance of more political stability, particularly after the German election, if a new coalition is in place and take more action on economic policy. So, I think if you were trying to draw a narrative for next year, it is plausible. You could see some upside risk in Europe relative to the baseline.
Are we entering an era in 2025, and perhaps we're already in one, where there's an element of complacency around political volatility, not just coming from Donald Trump, but the gyrations in French politics, potentially in German politics as well? I'm struggling to see how that's getting priced in day to day, as opposed to simply limiting exposure altogether.
I think totally. I think there's been a lot of complacency, because 2023 we had barely any elections. And although we had a lot of elections this year, 2024, actually, with the exception of some individual instances like France, which actually came as a surprise, there hasn't been that much volatility directly as a result. So I think that's going to be more of a story in 2025, particularly as some of these new governments, like the new Trump administration, get their feet under the table and start taking action, particularly when it comes to things like the threat of tariffs or more fiscal stimulus on the table, or as we've seen this week, the prospect of another government shutdown. These things are going to become more regular as we look forward to the next 12 months.
Henry, something else we're looking ahead to is maybe a continuation of the AI boom. Maybe we start to see some cracks. How are you looking at that story in 2025? Because there's a lot at stake for US markets in particular.
Totally. And one of the big stories, of course, has been this rising concentration of the Magnificent Seven, and their fate is basically determining the fate of the broader market. So I think all rests on how the Magnificent Seven perform. If they can't live up to the hype, and there is a lot of hype clearly, then that's going to drag down US equities more broadly. So I think that's the real test. I think the question is, though, are we going to see economic growth continue? Because it's can we get those upside surprises? Because the last 2 years we've had big upside surprises on growth. Even 12 months ago, there was still a lot of residual fears that the US was headed for some sort of hard landing. But that's now gone completely. So for me, it's just difficult to see where you get that upside surprise from. And if the Fed do become more hawkish, and we know those tech sector stocks are much more sensitive to rates, then I think that's potentially a real risk for that group and for the broader equity market.
They're sensitive to rates, and something that rates are sensitive to is the mood in the bond market, and the return of bond vigilantes is another of the themes that you're calling curveballs for 2025. I mean, what do you think the role of bond vigilantes will be, in particular around US debt in 2025?
Well, I think it's waking the market up and waking politicians up for that matter, because even in the last 6 months, we've obviously had the bond vigilantes focus on France, where the gap and the spread between their yields and Germany has hit its highest since the euro crisis. We've also seen, obviously, a big focus on the UK, actually, since the budget as well. So that's 2 G7 countries, which you might traditionally think of as safe, have come under attention. And
the long end of the US curve, maybe a little bit? Is that something that stocks will watch?
I think totally. I mean, actually, if you look at real yields, we're already up to the highest since May, and some of the highest we've seen in the last 5 years. So I think that's a real risk. And if we look at the next 4 years in particular, we know that Trump has said he wants to extend the Trump tax cuts that expire at the end of 2025. We know the CBO have said that debt to GDP is forecast to exceed its previous record set after World War II over the next 4 years. So we're genuinely entering uncharted territory on that front. So I do think there is a risk at the long end of the US curve.
Are puts still cheap, and should I be buying them?
That is a tough one. I'm just burned by the fact that the last 2 years have surprised so much on the upside. I guess the thing that gives me pause now is because we've had those upside surprises, valuations are increasingly stretched at 2021 levels. And also positioning is much more stretched. Our analysis suggested, at least before this week, we were in the 93rd percentile for equity positioning, which is a big difference to where we were at the end of 2022. Even though people were very pessimistic, actually, if we look back with the benefit of hindsight, we can see your positioning was very underweight. There was a lot of scope to...
Is it harder to get upside than downside in 2025 in equity markets?
Yeah, I think so, definitely, because the benchmark on growth has been risen. And also, markets are pricing in a very benign story in terms of both inflation staying subdued and that we're still going to get rate cuts. That's still priced in. And if you look at what the Fed have done this week and the market reaction to that, they still have an easing bias at the end of the day. The Fed are not that hawkish. They cut rates. And they said they'd want to continue cutting rates in 25 and 26. Yet the market still sells off 3% on the back of that. So just imagine if they actually became properly hawkish or said we're going to remain on hold.
Put's cheap.
As I say, I'm burned by the last 2 years, and our base case. I think things will continue to go further from here. I don't think we're fundamentally overvalued, but clearly there is a lot of froth in the market, and you can see that in sectors like Bitcoin hitting all-time highs. You can see that in credit spreads being very tight. There's a cross-asset phenomenon that's going on here, but I'm wary of calling the end just yet, particularly if we have those productivity upsides from things like AI that have really surprisingly upside in the last couple of years.
If there's an inflation uptick, as everyone is bracing for, is it the same playbook as 2021?
I don't think necessarily, because to get to the same playbook as 2021 and into 2022, you would need some sort of very, very big inflation shock that is sending inflation up to the 6s, 7s, 8s, as we saw then. And barring some new geopolitical shock, it's hard to imagine if it were just simply the things we already know about, like the tariffs, like fiscal stimulus. It's hard to see how inflation gets that out of control again, barring some big shock like that. Plus, of course, in 2021, we had the pent-up demand effects from the pandemic. We had the effects of the lockdown and all the massive fiscal stimulus that was working through. So I don't think that's the playbook. I think instead the risk is that the Fed keeps rates on hold for a lot longer than people are expecting, because I think there's going to be a very high bar at the end of the day for the Fed actually reversing course, because having moved quite aggressively since September, they've said they've got an easing bias now. I think there's a credibility issue, not that there should be necessarily, but I think there would be a credibility issue to them saying they were going to reverse course again, particularly after the most aggressive inflation since the early 1980s. I think there's that sense that they don't want to seem as though they've made a mistake in cutting and they're reversing all of a sudden quickly. So I think there's quite a high bar to them pursuing aggressive rate hikes again.
So we may be paused for quite a long time, Henry. I mean, I suppose government policy, though, is pretty unpredictable at this point, and they could make an argument that all those facts have changed and therefore they changed their view. If we were to see the Fed pivot towards hiking, I mean, I'm not sure anybody's sitting here saying that's happening in the first half of next year, but we got the beginning of last year really wrong.
Yeah.
So, I'm just wary of that.
Yeah.
We, as a sort of collected entity.
Yeah.
Yeah.
And I think it's worth bearing in mind there are potentially upside curveballs. I know you talked about those curveballs. I mean, one thing that I kind of heard in your earlier segment is, what if the geopolitical risk is on the upside? What if, Trump does come to some sort of grand bargain with China? We know he fashions himself as a deal maker. In his first term, he renegotiated NAFTA from the USMCA. Just before the pandemic, they did reach a phase 1 deal with China. I think Trump's going to want success. And actually, if you look through history, often it's under hawkish Republican presidents where you get those big deals. You saw under Ronald Reagan.
Doesn't pain come first, though? If you're going to do that deal, you need to inflict pain first. You need to use the stick before you kind of generate that kind of a deal coming through. Doesn't that generate the market volatility?
I think to some extent, but already he's generating pain with the tweets, even before he's president. And those people on the other side, like Canada, Justin Trudeau coming down to meet him, they're already reacting to that. And you see, Ronald Reagan did the Plants Accords. Richard Nixon, again, a hawkish Republican, did the SALT talks that led to the anti-ballistic missile treaty. So, there is a precedent for these kind of deals being reached even under quite hawkish presidents. So I think that's a possibility.
Henry, we'll see what happens next year. Feels like we've got a very cloudy crystal ball right now. Henry Allen, macro strategist, joining us from Deutsche Bank Research. Let's take a look at the core 6. This is what we are looking at this morning in terms of the main stocks that are moving around Europe. As you can see, some fairly substantial moves for some of the biggest stocks. ASML's down pretty hard. Schneider's down a reasonable amount. Nestle under significant pressure, which is interesting as well. But LVMH is soft. Novo's soft. In fact, they're all soft. Joe Easton, what have you got? Any green?
So one space there is no green is in the pharmaceutical space. Actually, a couple of big movers, a couple of big droppers in the pharma stocks today. Firstly, Zealand Pharma, the one we flagged earlier, over in obesity, dropping today over in Denmark after saying that the FDA in the US is unlikely to approve its latest obesity drug for now. So that stock getting slammed. It's down 9%. Bear in mind, it was up around 100% year to date going into this, but that drop is even beaten by Idorsia. Now, this is a rare drug maker over in Switzerland, announcing some funding issues, which I believe is related to an antibody and blood pressure drug. That's what the statement says, and that stock down 40%. Massive declines for that stock today. Then over in building materials, we've got Hornbach giving a bit of a sales warning out of Germany, potentially some weakness in the German DIY market this morning. That's what the statement is indicating. So that one dropping around 10% currently this morning. Then in terms of those sportswear stocks, we had that big move initially in Nike in the aftermarket hours, Nike, but it did come down into negative territory. And we are seeing a little bit of weakness in a couple of peers. JD Sports was the one that's a big Nike retailer, actually. Very small declines in that one, but Puma coming down around 1.2%, a couple of movements on that sector today. Then in terms of rating changes, BE Semi, now this is apparently the stock that you should be buying in the chip space. It is the top pick over at Morgan Stanley, and they've got a decent price target on that one, about 10% upside to their PT, and that one gaining 1.3% today over in Amsterdam. And then finally, IAG, the owner of British Airways, another stock that's doubled this year. It's got another buy rating. This is coming over from Goodbody this morning. They've got a 400 pence price target, trading at 302. A big rebound in long-haul travel continues, and they say you should be buying IAG, and that one is rising this morning in London.
Joe, thank you. Joe Easton with the movers today. Let's just go to the downside of the Stock 600 right now. The worst performing sector is the banking sector. And Kriti, you talked a little about UBS earlier on. That's one of the areas of weakness in financial services. But within banks, the worst performer is Deutsche Bank. And we do have these headlines just crossing the Bloomberg terminal around Deutsche Bank saying they've increased their capital of their Polish unit by 300 million euros. So there's some news flow there. And there had been some reporting around this earlier on coming from the German media. So that's certainly something we are keeping an eye on this morning.
And in terms of UBS, I already said it, I will say it again. We are anticipating a report coming out of the Swiss Investigation Committee, simply this idea that it could affect how many capital requirements UBS has, putting a little bit of a handcuff situation on it in terms of how they can compete with some of their global peers. Reuters reporting, I believe, that report due later out today, but we are still waiting. Banks broadly are down. Popular is down, CaixaBank's down 1.7. Some fairly big banks that are down decent numbers this morning. BNP's down 1.6%. Is there a banking story going on? The entire banking sector I'm looking at the moment, SX7P down this morning across the board. Every single stock. Another headline from Deutsche Bank just reiterating their outlook. So in case anybody thought they were not.
just in case we had some concerns. Coming up, President-elect Donald Trump threatening the EU with tariffs unless it buys more American oil and gas. We're going to talk about that much more next. This is Bloomberg.
Welcome back to the opening trade. 8:18 this Friday morning here in London. And the session looks like this. It's negative. DAX and CAC in particular under pressure. But broadly across Europe, we see weakness coming through. And it's pretty broad-based. Banks, financial services, the worst performers. Let's talk about the UK market, though. UK stock bulls await vindication in 2025 with an enticing discount and large shareholder payout tailwinds for the market. The FTSE 100 has managed a more than 5% gain this year. I'm seeing things. Though it's still lags the Euro Stoxx 50 and the S&P 500 by some margin. For more, let's bring in Bloomberg's Michael Masika with details on the UK's prospects. Good morning to you, Michael. So why are analysts positive then about the prospects for UK stocks this coming year? I feel like we've seen this movie before.
Yes, we've seen that before. Good morning. It's a market that is usually quite defensive. It's a market that does well when things go slightly wrong. You know, for next year, a lot of uncertainty about tariffs, uncertainty about rate cuts. We just had that this week. You know, just more uncertainty is kind of good for the UK. You have a market where you have large caps, very cheap, with very high payouts, and a lot of defensive stocks in this market. So why not have a good year for UK stocks? I mean, on a relative basis, of course.
In terms of kind of how that manifests itself, is that just I buy this for the payouts, I buy this because I'm expecting M&A? Kind of walk us through, are there other factors at play here?
So we've seen it this year. The UK was one of the most active markets for M&A. So you have a lot of that in this market, and it's mostly on mid caps, but you can see it's switched to large cap as well. There's like a willingness to bid for UK stocks because they are very, very cheap. Yeah. Even with a very comparable in a very comparable sector activity, like oil and gas, for example. You have UK oil and gas stocks trading at like a massive discount to their US peers when the business model is exactly the same. They're making the same kind of money. They're paying more dividends. They sometimes do more buybacks as well. But they're still trading on a very low multiple. So that needs to narrow somehow.
I'm surprised by how many Fed cuts were expectedly priced in this market, and not in the bond market, but in the equity market. You talked a little bit about positioning, and you've written certainly about the positioning story as well. But does the U.S. equity market really need Fed cuts priced into it to be the outperformer in 2025?
Probably not. To answer the question very shortly, the market doesn't need that many rate cuts, especially if the economy is doing well, which is what it's doing at the moment. And that's also the reason why the Fed had some kind of a pivot. You have like some inflation pressure coming in. You don't know what's coming up with a tariff next year, how much inflationary are going to be Trump's policies. So, I mean, they're getting more cautious. The problem is you have a situation where the market comes like max out long, like asset managers are maxed out on US futures. You had CTA that were almost maxed out as well. So you have a lot of forces in the market that pushed it higher this year, and suddenly, you know, there's a little bit of a drawback and a pushback from the Fed. So you think maybe it's time to trim a bit the exposure.
Michael, can I ask you a slightly curveball question, perhaps? But, you know, you operate in this area of light, which is quoted public companies. On the side, we see the rise of private markets, and that's been a theme that's been building for years. We talked about it a lot on this programme. Is this having an impact? We talked about some of the mid-cap M&A stories, for example, in London. I wonder if that's a lot of take privates. I just wonder what conversations are you having about that, or does that stay very much off your radar?
Well, from what we see, there is a lot of interest in this, in take private, especially in the UK market. Now, having said that, we don't have like proper data to back how much, you know, this might continue or not. But we've seen it this year. There's a lot of interest from private equity into the UK market and into other markets. But if interest rates stay elevated or more elevated than we imagine, maybe financing is going to be more difficult, and you'll have less activity in that on that market.
All right, Bloomberg's Michael Masika. I'm sure we're going to be tapping you plenty into the next couple of days and into the new year. We thank you so much for joining us around the table. Let's talk about the other news this morning. President-elect Donald Trump is threatening the European Union with tariffs if member countries don't buy more American oil and gas. In a Truth Social post, Trump saying if the EU does not make up its deficit with the United States, quote, it's tariffs all the way. Joining us now is Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. So it begins. Will, how likely is it that those tariffs come, given that Ursula von der Leyen has already kind of made the opening offer on buying natural gas? Is this a kind of just saber rattling at this point?
I think Trump's pushing at a pretty open door here. Europe is buying a lot more oil and gas than it ever has done before. If we look at oil, we're up to 2 million barrels a day, 23% more than last year. If we look at gas, clearly the European economy can only function because it's replaced most of the gas it used to buy from Russia from the United States. I think that European officials have said that they would like to replace the remaining sliver of Russian gas, which is both LNG and this pipeline gas for Ukraine, which we think is likely to stop at the end of the year. I think officials would like to replace that probably with imported gas, mostly US, and the US is building more gas export plants. So on the gas side, I think clearly it could happen anyway, and Trump is sort of doing his thing.
This feels very transactional. Hasn't the problem been that actually the Biden administration has made it harder for us to buy gas out of the Americas? Like the messaging coming out of the Biden administration has been a little bit more difficult in terms of the narrative.
Well, they had put a moratorium on building new gas plants, but that hadn't impacted any gas exports now or in the next couple of years. Clearly, on a policy, from a policy perspective, the Biden administration in the EU talked a lot more about decarbonisation and perhaps not using as much gas. That talk is all going to go out the window. And honestly, when you look at what's going on in the German economy and the angst about energy prices in Europe, I think they're going to be pretty willing to buy what is, in a global context, good value energy from the US. So I think, Trump's putting himself in a place where he can almost make his point and declare victory.
There you are. Well, yes, sometimes we need some quick wins, don't we? What about the price of oil right now, Will, as we head towards the end of the year? 72.47 on Brent. I mean, drill, baby, drill has been a mantra. He seems to be happy to sell a lot more energy products to Europe. I wonder how low he's prepared to push prices.
I think he wants low prices. Clearly, in US politics, the price of gas, what people pay at the pump, is an enormously prominent, and it's really seen by a lot of American consumers as a proxy for inflation. So he won't want to see that rise. There is a little bit of gloom about the oil market next year, partly because US production will continue to rise, although how much Trump can actually make a difference, I think, is a moot point. Okay. But there are lots of things we don't know yet. We don't know what's going to happen to Iran, and we don't know what's going to happen to the Chinese economy.
Thank you so much, Will. Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. When we come back, we'll talk European politics some more. This is Bloomberg.
I'd like to suggest to the upcoming presidencies to be brave. Well, this was our slogan for our presidency: "Make Europe great again." This is our only chance. Thank you.
The Hungarian Prime Minister, of course, Viktor Orban, speaking at the EU Leaders Summit yesterday. Let's get more from that summit and what we've learned from it. Bloomberg understands that Viktor Orban has told European leaders that he wants to wait until the inauguration of Donald Trump before deciding whether to extend the bloc's sanctions against Russia. Let's talk more about this. We're joined by Bloomberg's Ollie Krug. Ollie, how have those comments gone down with other leaders?
Yeah, so listen, Guy, I mean, Orban is kind of the disruptor in chief here on the EU on a number of different issues, but perhaps none more important than the issue of Ukraine, particularly when we're getting out of European leaders. Some of the same comments we've heard repeatedly from them since the beginning of the war, reiterated by von der Leyen last night. The main message today was full support for Ukraine as long as it takes. What that means is trying to bring in more sort of military gear to the battlefield, but realistically, that's really sort of maxed out here in Europe to a certain degree. There's not going to be any major breakthrough here. The real concern is actually subtracting some of the supportive measures, and that is namely on sanctions. We have had 15 rounds of sanctions from the European Union because these need to be re-upped every 6 months. They need to be re-ratified by the EU 27 members of whom, of course, Hungary is one of them, and can block it. What we understand is that Orban now is not willing to sort of roll over these sanctions until the inauguration of President Donald Trump. That is on January 20th. The next deadline for those sanctions to be rolled over is January 31st. And this is just sort of part of the whole constellation here in Brussels over the last 24 hours or 48 hours, where basically Trump is looming large over everything. And there's this very clear sense that Europe is really just in reaction mode, waiting for this presidency to come underway. And the question is, how much of an impact will Orban have? We are getting some other ideas. We should say, Valdis Dombrovskis, for example, the European Commissioner for the Economy, says that we shouldn't abandon the idea here in Europe of looking at not just taking the proceeds from the frozen Russian assets, but actually tapping the underlying Russian frozen assets, getting those to Ukraine. That is obviously much more complicated, much more controversial. When I spoke to the Luxembourg Prime Minister going into the meetings, he's part of all these discussions with all the leaders in Europe. He says that that's really not on the table, but this is something that some leaders want to continue exploring.
OK, and we were just looking at images of Volodymyr Zelensky arriving at the summit just this week, Ollie, and there's been some news flow surrounding Ukraine and Putin and the deal around gas for Europe. Fill in the gaps for us.
Yeah, so listen, this is something that has been a very sort of a strange feature of this war since the very beginning, where you still have Russian gas that's flowing through Ukraine. Ukraine's getting paid for that and then being delivered to Europe, which is paying that money to Russia, which is then using that money to wage its war on Ukraine, which, of course, the Europeans are trying to prevent and fighting against. This has been just a sort of very strange dynamic since the very beginning. And there are these sort of transit agreements that basically guarantee that this gas can go through Ukraine. Those were set to lapse at the end of this year. There was a lot of questions about how to maybe work around it, because this would hit a number of Eastern European economies within Europe, namely Slovakia. But basically, it will not be renewed. This is what we heard from Zelensky. This was something that we were sort of debating when we spoke to Zelensky earlier this year. The question is now, because this is only about 8% now of European gas, so it's not inconsequential. It's about 15 billion cubic meters of gas every year. That's down from the 150 that came from Russian pipelines before the war. But again, it still has something of a material impact. We saw natural gas prices go up about 6% yesterday, and the natural gas storage facilities right now are much lower than they are in traditional years here in Europe. But basically, overall, Europe is much better positioned to deal with this, but it's still significant within the market.
All right, Oliver Crook, we thank you so much for breaking the story down, joining us out of Brussels this morning. Let's take our news and look over at France as well, where Bank of France Governor Francois Villeroy de Gallo has urged the government to target a significant deficit reduction. New Prime Minister François Bayrou says he hopes to name a new government by Christmas. Joining us now to discuss the latest is Ludovic Subrin, chief economist over at Allianz and a member of the French Council of Economic Advisors. A pleasure to have you on the program as always. Let's just start with how likely it is that we do actually get a budget. What does that timeline look like? Are we looking at months, weeks, days?
Well, it counts in months, in weeks and days. The idea is mid-February. So you see, you can count in all three units. Look, François Bayrou seems to be confident he could name a government before the end of this week. That means by COB tonight or before Christmas, he said. But more importantly, there are good grounds for a budget by mid-February that would be friendly, I would say, of the demands of the far-right party, which is really the topic. So that would be maybe a less ambitious budget, so less than a point of adjustment, fiscal adjustment. But that would, for example, not touch on healthcare and pensions, which is a big middle-class topic that the National Rally has been focusing on. And that would also be maybe less ecologically punitive, which is also one of those topics that the far-right parties are pushing forward these days. So Bayrou seems to be confident he can get that by February. The good news is that we have a special law for budget So it's a bit business as usual with, some adjustments actually in the making from that special law, especially the fact that income taxes will not be indexed for inflation. And so most French people will have to pay a bit more taxes on 2024.
So the austerity baked into that loi speciale actually helping in a little bit for in the meantime. Walk us through, though, the effect, understood, very little, the effect of the markets here, because there's a conversation that as you start to see the spread between French and German debt widen, even if it is slowly, there are financing constraints placed on French corporates, on French citizens as well. Can you connect those dots for us, the market moves versus the actual economic impact?
Look, I mean, first, the good news is I think markets are reacting quite positively. There is a spread that is there that is basically rooted in the additional political uncertainty and fiscal uncertainty on France, and that has been on since June. There was a bit of widening when the government resigned, or actually the no confidence vote was passed. But then since then, it's actually very much under control. So we're talking about 80 bips of spreads with Germany. Give or take, which is okay. Of course, the problem now, it starts to pass through to the corporates. And as you can imagine, it will also pass through on mortgage rates, because even though the ECB continues to loosen monetary cycle, you can imagine that the fact that the French, issuances have a bit of a risk premium, even if it's 20 basis points, is something that will certainly play into the bank's likeliness to lower even faster the mortgage rate. So there is these financial conditions that are a bit on the tighter side. It's quite slow and it's quite circumscribed. The big issue, as you know, with this spreads topic is, of course, the nonlinear nature of them. So right now, there is no fear priced in. There is just this uncertainty priced in. But of course, everybody has been talking about the president resigning. A lot of people have been talking about the situation being worse than it is. So there is this risk that it could actually jump to 100 basis points. I think it's a low likelihood scenario, but this would have a bit more effect, of course, on the corporate financing, on private equity, on leverage buyouts. All of these financing conditions that France has actually been benefiting from the loosening cycle from the ECB could be halted a bit should this situation continue. But it's okay for now.
Ludovic, the incoming US President, Donald Trump, has posted this morning talking about the idea that the Europeans need to buy much more oil and gas from the United States, or it's tariffs all the way. Is Europe focused enough to deal with Trump right now?
Look, I do think we are. It's true that the problem is, the fact that Germany is going for elections, the fact that there are a minority government in a series of countries. We are looking a bit too much at our belly button, to be honest and to be blunt. But as you know, markets are extremely driven by the Trump playbook, including the 333 of Secretary Bessent. So, of course, the drilling and the oil is an issue. I do think it will get better by the first half of the year, especially when we get a new chancellor in Germany, because then everybody was going to be about, okay, do we go for a tit for tat, like Italian law type of situation with Trump? Or, as Christine Lagarde pointed out in an article, do we negotiate? And especially on defense and on oil and energy. I think the Europeans are much better off negotiating. And I think this is the real learning from Trump 1 was, the more you negotiate, the less likely it is that you get extremely, negative sanction batches, right?
But you have to spend and you have to deliver on defence. Is Europe capable of making those big decisions? Is Germany, France capable of making those big decisions at a point when we have such economic uncertainty and political uncertainty? You need to have a pretty clear idea of where you're going in order to make some of those big decisions. If we're going to boost defence budgets to 3%, if we're going to buy much more oil and gas, all of these are, the oil and gas maybe is an easier one, but these are big decisions that Europe has got to make. And I'm just wondering if Europe can move quickly enough to satisfy Trump's agenda.
Look, I mean, there is, on paper, I think President-elect Trump has an issue with who is his counterpart. Because, is it Ursula von der Leyen? Is it Antonio Costa? Is it Emmanuel Macron? Is it the new Chancellor of Germany? This is the problem. But in reality, all of these people are very much aligned. I think the two main candidates for Chancellor of Germany have shown that they're very committed to increasing defense budget. I think there is no doubt that Macron, Meloni, Sanchez also want to do that. So I don't think we have an issue here. The big problem is more the substitution effect. So if the fiscal is tied to 2% or even 3%, which is the latest NATO member type of discussion, defense spending, how do we finance the rest? Social protection, infrastructure. And this is when the other building blocks come together, especially, maybe we will get Eurobonds for defense, but that means, we will get more subsidiarity on other topics like climate, or maybe we need to be a bit smarter on this so-called savings and investment union. That means the capital markets union, because we will need to get additional financing from the banks and from the markets on some of these other topics, especially infrastructure, transport, green, and so forth. So I think the commitment we can get there at the speed of Donald Trump. I think the implementation will take us longer because some of these blocks, institutional and financing flows, are not there yet. Yeah.
Ludovic, I'm going to give you a challenge now. We've spent today thinking about 2024 and pushing ahead to 2025. And I wonder what we'll be talking about this time next year. I mean, do you have a sense of the way that next year is going to unfold? Or is there just too much fog, to use the metaphor that one of the metaphors that Jerome Powell was using this week?
Look, I think it's going to be a three-sequence year. First third of the year, it's going to be US, US, US. Second, it's going to be Europe, Europe, Europe. And third, so when we're going to be talking again next year at the same time, it's going to be China. Because by then, we're going to see a bit whether the Chinese stimulus worked. And we're going to be a bit clearer on how much of a trade war we're talking about. So it's going to be very determined in this way. So let's get tuned for, all eyes on America for the first third, then all eyes on what Europe can actually do. And then it's going to be China. And thank you for showing our weekend outlook. We're very proud of this one. I've always been a musical fan, and the team actually bought into my craziness one more time. So it is worth a read, I hope. I prefer the musical over the movie, but, I hope you guys got all the puns and jokes intended. Yeah.
That's okay. Ludovic going with the original. Thank you very much. Ludovic Subran, Chief Economist at Allianz. Thank you so much for joining us, and we wish you a pleasant end of year, New Year and 2025. Now, the US Secretary of State, Anthony Blinken, expressed cautious optimism about the prospects for a ceasefire deal in Gaza. Speaking to Bloomberg's David Gura in New York, he says the chances of a deal have now improved.
The reality is we should logically be able to get this. And I say that with all the caution that comes with that statement, because, we've been very close before, and we've had these Lucy in the football moments where you're just ready to kick the football and Lucy pulls it away. But what's changed is this. Hamas knows that the cavalry is not coming to the rescue. For months and months and months, it hoped it would get a wider war with Hezbollah, with Iran, with Iranian-aligned groups coming in and creating more problems from Israel on more fronts, and helping Hamas endure. We now know that's not happening. They know it's not happening because of the very important work that was done with us and with others, dealing with the unprecedented Iranian attacks on Israel, dealing with Hezbollah. So I think that's concentrated minds among Hamas on the need to complete this deal. Having said that, it's always incredibly fraught, and it's very hard to get decisions made. It's hard to communicate. And for all of those reasons, even as close as it is, it can still move in the other direction. But we've all been fanning out, working with all of the different partners who can make a difference and who may have some leverage with, communications with Hamas, whether it's Qatar, whether it's Egypt, whether it's Turkey, where I was just last week. The fundamental question right now is Hamas finally prepared to say yes? And if it does, we get the hostages back. We get a ceasefire. We get an immediate, dramatic improvement in the lives of Palestinian children, women and men who've been caught in this horrible crossfire since October 7th of Hamas's making. If they really purport to care about the Palestinian people, they will say yes and do it now.
US Secretary of State Anthony Blinken, there was his thoughts on Middle East developments. Away from that area of geopolitics, Guy, we do have some weakness to talk about in US futures this
It's worth paying attention to. So coming into this morning, the number that you needed to know was 59.06. That was the low post-Powell in E-mini futures. We've now cleared that to the downside, which could open up significantly more weakness as we come through into the session a little bit later on. We're now trading below 59, 58.94. Coming into the session in the United States a little bit later on, but we're already starting to price that in, obviously, in terms of our thinking this morning. So we've cleared 59.06, 58.94 is where we are now trading on E-minis. Coming up, a government shutdown looming in the United States, a factor in what I've just been talking about. More on what we should expect after the Republican-led House rejected the funding plan backed by incoming President Donald Trump. That's next. This is Bloomberg.
Very disappointing to us that all but two Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon. Again, the only difference on this legislation was that we would push the debt ceiling to January of 2027.
U.S. House Speaker Mike Johnson speaking after the Republican-led House voted down a temporary funding plan backed by President-elect Donald Trump. Now, the rejection sets the stage for a potential U.S. government shutdown, with funding set to lapse tonight, midnight time on the East Coast. Let's get the latest now with Bloomberg's Joshua Gallu. Joshua, pleasure to have you on the program this morning. Walk us through what happens if there is no deal. What are the next steps, first on the shutdown and then on the debt ceiling?
On the shutdown, that would happen at midnight tonight if there's no deal. That's the deadline. The continuing resolution that they're talking about is really meant to keep the government running only for another 3 months, and then it would have to be done again, or a proper budget would have to be discussed. If they hit the deadline tonight, then essentially the government shuts down tomorrow, which really doesn't, on a Saturday, it doesn't have as much effect as it will on Monday. But you start to lose services, national parks will be closed, and you will probably have a lot of disruption in travel if TSA employees, for instance, don't entirely come to work when payment starts getting delayed. It usually doesn't have a major impact initially, but in this case it could. And with holiday travel happening right now, I think people are not going to be very happy about it. In terms of the debt ceiling, that is something that has a much graver effect.
Then, Joshua.
Sure. The debt ceiling was essentially, this is something that allows the government to borrow to fund its expenses. And back in 2023, they made an agreement to table that issue for 18 months so it didn't interfere with the elections this year. It expires on January 1st. That means that the government will not be able to issue new debt, but instead, Treasury, through emergency operations, will be able to fund the payments that it needs to make. That can't last forever, and the experts say that would run out around summertime. So the debate over the debt ceiling has always been expected for the first half of this first year of Donald Trump's presidency. But what happened and why this fell through is that it was not part of this continuing resolution debate. Trump wants to fit it into Biden's presidency at the last hour, so he doesn't have to bear that burden. But he wants to extend it for 2 years or get rid of it altogether. That's a very unpopular opinion in his party. So what you've seen is that the more conservative Republicans have said, no way. And they've fought against this provision that Democrats have actually looked for in the past. So the likelihood that the most conservative people in the Republican Party would then get on board for and vote for extending the debt ceiling doesn't look very likely.
Joshua, thank you. Thanks for bringing us the latest. Bloomberg's Joshua Gallu with the latest developments stateside. In perhaps a sign of things to come, President-elect Donald Trump is has been busy in early European hours, threatening the EU with tariffs all the way. So more tariffs. We're joined now by Bloomberg's Valerie Teitel with some guidance on this subject. We've been watching for evidence of this in stocks. I mean, stocks are weak in Europe, but they're also weak in the States, Valerie. So I'm not sure what that tells us. I guess let's look at this from an FX lens. Implications for the dollar.
Yeah, I think this tariff threat, both of these options that the negotiation can go are both positive for the dollar, which does complicate Trump's success in some way. Either if he goes ahead and puts tariffs on the EU, or if he is successful in closing this trade deficit, if he is successful with getting the EU to buy more oil and gas, that is another dollar positive. Buying more U.S. goods, increasing that trade in terms of U.S. exports is going to increase demand for the dollar. And I think this is where the pickle really lies here, Anna, is because for Trump, he really does need to have a weak dollar going forward if he does want to revive U.S. manufacturing. He also seems to think that these trade deficits, he's calling them as the U.S. subsidizing other countries. He claimed that when he was speaking about Canada a few days ago, saying the trade deficit with Canada is the U.S. subsidizing Canada. So he really does want to get rid of these trade deficits. But again, that is a strong dollar policy. It is going to complicate how he reshores U.S. manufacturing.
Plaza Accord? Is that the kind of the logical? Is that ultimately where this goes? Some sort of deal like that weakens the dollar, others spend more. That's the change that we need to see.
I think that could be a real theme for Q1 of next year, a Mar-a-Lago Accord, should we call it? Because for Trump to claim success for these policies he wants to push through, he does need a weak dollar in the background. And let's not forget, a hawkish Fed, like we got a few days ago, only makes that worse. Yeah. We saw the dollar jump.
So are we setting up a fight there as well?
Perhaps. We do have a Fed on hold for much of next year alongside other central banks cutting, like the ECB, like the Bank of England. Yep. That only poses more dollar strength and perhaps presses the need for some weak dollar policy to come out of the U.S. administration.
All right, Bloomberg's Valerie Teitel walking us through maybe what's going on in Donald Trump's mind. We thank you so much. Later today, we're going to get another view. We're going to speak with San Francisco Fed President Mary Daly on the Fed's decision and the outlook for next year. That coming up at 12:30 p.m. UK time.
You guys are done, aren't you? That's it.
Yeah, we are.
Christmas is coming. I'm gonna be here next week, but you're not.
Well done. Thank you.
Okay.
That
takes
taking
us,
one for the team.
Takes us into the weekend. You guys, I'm sure, are going to be doing your Christmas shopping, getting ready for the holidays. There are other things happening. It's got the Tottenham Hotspur Liverpool game, the Spurs Liverpool game. I'm actually more interested in the Villa City game. I think that's going to be absolutely fascinating.
I like how he thinks we haven't done the shopping already, and we're not.
Have you done the shopping?
Yes. It's
okay. Have you done the shopping?
It's the 20th,
I think there's evidence this morning that I've done my shopping. Yes, absolutely.
That is fair enough.
Are you going to be seeing The Lion King? Are you going to be having carols at the Albert Hall? Are you going to be watching? Are you going to be at home to the Furies?
I'm not going to be watching any of those things. I can tell you, there's no darts on the list, so I'm moving swiftly through the weekend teaser. Let's go to the Blackstone video, shall we? Because this is a festive tradition now. The 2024 one dropped, and it seems, Guy, you make a cameo. I mean, it's brief.
Quite far in. It's very brief.
It's brief, but it made me think, what do we need to say this year about the video to make it into the video next year?
Well, there was
getting quite meta.
Maybe some hidden talents.
There was a good chunk of Taylor Swift talk as well.
In the background.
Made a quick debrief, but there was a Taylor Swift theme to it, and I think maybe your fangirling has finally paid off.
It is. That's how we made it. I remember it being a big deal last year. It's very entertaining. You'll find it online. It is definitely worth watching.
But Private Markets as reality TV, that's genius. Make that programme. There you go. That's my attempt to get
the Larry Fink cameo is the best bit.
That was excellent. That was genius. That is it for the opening trade. The Pulse is up next. Have a good day and week, everybody. This is Bloomberg.